All right, good afternoon, everybody. Welcome to my weekly market webinar. Glad to have you guys join me. It's been, I've cut these back. I'm probably doing them once every couple of months as things necessitate. Things had calmed down, but clearly they're not calm any longer. And I had a few people ask me if you can get another webinar up and running to catch us up. So I'm doing that. And I'll add these as necessary. If things stabilize, then we don't need them. If they keep going crazy like they are right now, I'll keep you updated. So thank you everybody for joining me. Remember to put in comments on the chat if you have questions. If you're watching via Facebook Live or through YouTube, then put comments in and I'll catch up on those comments later. But I've got a lot to cover and I want to get through it in a relatively short amount of time. So let's go ahead and dive right in. So what are we going to cover? First of all, we're going to take a look at the numbers and specifically talk about what the heck happened with interest rates in February, and then where are rates headed now? So that's about it. Like, as long as I tell you guys where rates are and where they're going, if my crystal ball is perfect, you guys will be super happy, right? Right. All right. And questions and answers, you're just not allowed to ask me exactly what tomorrow's rate is going to be. As long as we got that straight, then let's take a look. So the first thing is where are we at right now? The 10-year Treasury, which is not determining where mortgage rates are, but it's a very good indicator of where mortgage rates are going and where they're headed. The 10-year Treasury has gone up significantly from where it was last year. So this is a 6-month chart. This is going back and saying the 10-year Treasury had been around 0.6%, as that's what the yield or the return is if you had bought a 10-year Treasury bond from the US government. The 10-year Treasury bumped up some and it's kind of been on a regular uphill swing, and it got a whole lot worse in the last month. So I'm actually going to look a little bit closer here over the last 30 days. So the 10-year Treasury started out just about below 1% at the end of January. It went all the way up to 1.6% last Thursday. That is the biggest increase in Treasury rates that we have seen since November of 2016. That was the month that Trump was elected. Nobody expected him to win. The markets didn't know how to react and rates skyrocketed in November of 2016. We have seen a similar amount of movement in February, and everybody's kind of scratching their heads saying, what the heck happened? But we kind of got complacent. And I'll explain why we got complacent in a moment. But if you go back 6 months, you see that on a regular basis, the 10-year Treasury kept getting higher and higher and higher. So in a way, this should not have caught us by surprise, but it very much did. And here's what happened. If we go back 3 months looking at mortgage bonds, this is what a mortgage, remember I've shown you guys before, mortgages trade in what's called a coupon. And what you're looking at right now is the 2% coupon. And that's for any mortgage that is between a 2.25% and a 2.75% interest rate. It's packaged up and sold to Wall Street with a return on investment of 2%. So that 2% coupon, when a mortgage company would sell that to Wall Street would say, hey, you've got $1 million mortgage here, or $1 million worth of mortgages. We're going to pay you a premium. We're going to pay you anywhere from 3.5% to 4% of that $1 million as an initial payment to the lender for providing that investment. So this is called the value of the coupon. So that value of that loan was right at around 103, or 103% of the loan is what we would get when we sold it on the open market. We get to the early February and we're still right about that same amount, where we were getting about 3% of the face value of a mortgage as payment for a 2% coupon. That fell very, very quickly, all the way down to less than 100% of the face value. Last Thursday, if we had done a loan between 2.25% and 2.75%, a mortgage company had historically made for the last year about 3% return on investment. Now we're losing money. That drop from 3% to below 100% of the value of the mortgage literally happened in a 2-week time frame. Fastest I've seen rates drop. Now, what you notice is it rebounded a little bit. Friday was the first good day we had in almost an entire month. So it is a good sign. Today was another good day. If we can string together multiple good days, that's going to be hopeful for us coming out of this and not being in this channel or in this trend long term. What I want you to see is that this is also happening at higher interest rates. This is kind of how interest rates move up the chain. Is investors say, well, gosh, I'm not going to do loans anymore from 2.25 to 2.75, because if I do, I'm losing money. I'm not even getting 100% of the value of the mortgage. And so instead, I'm going to charge the 2.5% coupon. That's going to be rates from 2.75 all the way up to 3.25. And at that range of rates, we used to get paid 5% of the face value. We're now down to about 3% of the face value. That makes this what we call the current coupon. It's the range of where rates are is between 2.75 and 3.25, because we can't sell the 2% coupon anymore. We lose money. That's why rates literally shifted 0.5% within a 2-week time frame, because this coupon shift. So we're now making on a 2.5% loan what we used to make on a 2% loan. I taught you guys this a year ago. I'm going to take a quick minute and explain in a little more detail once again. People get confused when I show them this 2.5% coupon and saying, okay, that's a 2.5% interest rate. You guys should be willing to give us a loan at 2.5%. No, because all of the banking industry's overhead is built in there. We don't charge out of pocket for much of what our overhead is. We charge as part of the interest rate. We've got the cost of servicing the loan over the life of the loan, printing the payment coupons, managing the customer service, the cost of the originating bank, the cost of me as the originating loan officer. All of that is built into the interest rate. So when we are collecting between 2.75 and 3.25% from a client, Wall Street's really only getting paid 2.5%. That's why the range of rates have jumped from the low to mid 2s to the high 2s to really low 3% range, depending upon the program. Here's a specific glimpse into where interest rates are right now. So last Friday, if you guys get my weekly rate update, you see last Friday, rates were on a 30-year fixed in the low 3% range. And just late December, we were at 2.75. So we're seeing about 3/8 to 0.5% increase in interest rates on a 30-year. The 15-year has not gone up anywhere near as much. By the way, what you're looking at is purchase interest rates. Refinance interest rates are higher because Fannie Mae and Freddie Mac are charging a premium for the fact that you are refinancing a property. I'm seeing some clients, refinance rates have gone up by 0.75%. I had a client I had quoted back in January, 2.75% on a 30-year fixed. Today we looked at numbers and he's at 3.5. What's interesting though is back in January, I said, hey, you can do a 15-year. It's going to be about 2.4. And we decided it wasn't worth that minor savings and interest to lock himself into a 15-year payment. So he decided to go with the 30. Well, we've changed that thinking now because the rate on the 15-year only went up a little bit. And so he is much, much better off. If you are thinking or able to do a 15-year loan, the impact of the recent rise in rates is nowhere near as harmful to you as people who are doing 30-year loans. So something to keep in mind if you've got clients that have the ability to pay a 15-year payment, but we're just going on a 30 to have a little bit of payment relief. A 15-year rate is still super good, and they did not climb up anywhere near as high as the 30-year rates have. You see almost a 0.75% jump in FHA and VA rates. So we've seen FHA and VA rates be around 2.25 late December, early January. They're now pushing 3%. We're at around 2.99 on average. Jumbo loans, same thing. We've moved by about 0.5% in interest on jumbo loans. So pretty significant increase. But let's be honest, these are super, super good interest rates. We've just been spoiled for the last 12 months with extra low interest rates. If you could get something, I remember last March when rates first started really going down, the lowest I had ever seen before that was 3.25%. So to say right now we're at 3.125 on a 30-year fixed is still a super amazing interest rate. It's just not as amazing as it was last week, or excuse me, not last week, but last month. I want to point out something that a lot of people misunderstand. It is the weekly market survey. So Freddie Mac puts out a survey and they publish it every week on Thursday, saying what the week's interest rates are. The average 30-year fixed mortgage rate is 2.blank%. That's based on a survey done by mortgage lenders on Monday. So today, they are surveying mortgage banks to say where interest rates are right now, and they're going to publish that information 3 days from now on Thursday. It is behind the times. With rates moving as quickly as they're moving right now, you need to let your client know that. Because somebody's going to be talking to me on Thursday about rates, and they're going to say, well, no, because I just heard rates are this. Well, my rate on Thursday could be higher or lower, because they're actually asking what was the average rate for the last week, but they asked that question of lenders on Mondays. So what you see is Freddie Mac's weekly survey is this black line. And it almost always is lower than the actual daily average of interest rates. Because A, this is a weekly survey, and B, that survey only includes purchase transactions. If you're refinancing a home, your average rate is higher. Your average rate is always higher on a refinance because, as I mentioned a moment ago, Fannie Mae and Freddie Mac added a premium last year to any refinance, saying there's a higher risk because of COVID and they need to charge more on refinance loans. So just be super careful as you hear those news articles. Be extra careful when you hear advertising on the radio. I don't know about you, but I'm still hearing everybody say you can get a 1.9% mortgage. So everybody's still hearing those on the radio, 1.9% mortgages. The problem is in the fine print. It is legal per RESPA to advertise for up to 90 days after the rate effective date, because it's not appropriate to ask somebody to re-record their news, not their news, their advertising, their radio spot, their TV advertising. They can't re-record that every day with today's rates. So as long as they have a rate that they had for published to their clients within the last 90 days, they can continue to use that same advertising for 90 days. Well, that really is misleading because it means right now they're talking about rates that were available back in January. And it's bait and switch, pure and simple. They're calling and they're saying, hey, I called about the radio ad I heard at 1.9%. Oh yeah, no problem. Let's see what we can do for you. I just need to pull your credit. I just need to put your paperwork together. Oh, yeah, no, rates have gone up a little bit since then, but here's what I can offer you. And by that time, they've already got them hooked in. So please, please, please make it clear to your clients that that advertising is outdated. There is no such thing as a 1% interest rate. It doesn't start with the ones anymore. We're hopeful, fingers crossed, it's going to go back to that. But realistically, we're nowhere near that number. And that 1% interest rate is gone. So just be aware of that fact. So why have interest rates jumped? Let me show you a couple things. First of all, the cushion is gone. I've been telling you guys for the last year, mortgage rates are higher than they should be. And I'll remind you of why. Because if we rewind back to March of 2020 and you take a look at this chart, you will see the 10-year Treasury before March of 2020 moved very similar in line with mortgage rates. So the green line is mortgage rates, the blue line is the 10-year Treasury. And you saw that when the 10-year went up, mortgage rates went up. When the 10-year went down, mortgage rates went down. And then March of 2020 happened. And COVID and the shutdown and all of the economic issues came about. And the 10-year Treasury rate dropped while mortgage rates at the exact same time went up. And it created this cushion. And I've been saying for the last year, interest rates are higher than they should be because how low the 10-year treasury is, mortgage rates have not come down. A few reasons why, but to oversimplify it, the fact is there's been a cushion. So when you guys saw that chart back at the beginning of this meeting, and I said the 10-year treasury has been going up and up and up, and we have not been paying attention to it, it's because mortgage rates have still been going down during that time frame. But the cushion is now gone. As of January 1st, the cushion was gone, and we saw a spike in January of mortgage rates, but it wasn't that big of a deal because they came right back down. But now we've got the 10-year treasury going up significantly, and guess what it's dragging right along with it? It's dragging mortgage rates right along with it. So now the state of the bond markets is very much in control of the state of mortgage rates. And that has not been connected at all for the last year. So just be aware of that fact that the dynamics that were in play in a normal environment had been disconnected for the last year. They're now back in play. That also changes something I've been saying for the last year. So pretty much every one of these presentations I've done, I've said, guys, if you're purchasing a home, lock right away. But if you're refinancing, the industry's backed up and rates aren't going up at all. And so don't worry about locking until you get to the end of the process. Lock them when you can, including refinances. If you know somebody that's thinking about refinancing and the number is what we want it to be, we are locking right away at the beginning of the process. The good news is we've caught up. So we're getting refinances done in 30 to 40 days. And we're able to lock immediately, but gone are the days where we had this cushion that said no matter what happens with the 10-year treasury, mortgage rates are going to keep the same or go down. And the biggest question I get from people is, but John, the treasury has still said they're going to keep interest rates low. The Federal Reserve has said they're going to keep interest rates low. Remember, the Federal Reserve only controls money borrowed overnight. They control the rates that they charge banks for borrowing money between tonight and tomorrow. The banking industry works because banks loan out all the money they get in. So what happens if today Wells Fargo Bank loaned a little bit more money than they received in deposits and payments? They're going to be short tonight. Now they're going to get a lot more payments tomorrow when somebody else pays their mortgage payment tomorrow or they make a deposit tomorrow. So Wells Fargo has to go to the Federal Reserve and say, hey, can I borrow a couple $2 billion tonight? I'll pay you back tomorrow. It's no big deal. The Federal Reserve says, sure, we're going to charge you our discount rate. Their discount rate is currently 0. That's the rate the Federal Reserve controls. They do not control long-term rates. This is what controls long-term rates, and it has a lot to do with the economy. And I'll dive in a little deeper here in a couple of minutes. So what else is causing the rates to go up? Inflation. The other thing that's causing rates to go up is fear. Most importantly, fear of inflation. That's really what happened in February, is there's a lot of fear going on because there is no real inflation happening right now. I'm gonna take a quick second and I'm gonna give you guys a brief tutorial, a brief reminder, refresher course, Econ 101. What is inflation? Inflation is the increase in the cost of goods that are produced by the economy. So why does inflation go up? It's all about supply and demand. If there are a bunch of people that have a lot of money in their pockets and they're trying to buy a limited number of goods, maybe we all want to buy a particular car and there's only so many of that car and everybody wants to buy it. Well, then the price of that car is going to go up because everybody wants to buy it. That is part of inflation. There's a lot of components that go into it, but inflation very much is how much has the cost of goods increased. Well, we don't have inflation right now. We have it. The personal consumption expenditures, the PCE, is a gauge of inflation, and it came out saying inflation was at 1.5%. That's pretty tame. Okay, you want some inflation. You want to continue, because when prices of goods go up, that means the employers have more money to spend, whether that be on investing in technology, whether that be on increase their share price and shareholder dividends, or on paying their employees more. So some inflation is good, but too much inflation can be bad. And specifically, mortgage bonds, treasury bonds, are adverse or afraid of inflation. I want you to think about it this way. This is actually an explanation I've used with a lot of people, and I think you should use this when your clients ask you, John, help, I don't understand. What does inflation mean and why does it matter? Why is my mortgage rate going up? And I say to my clients, look, let's pretend your employer came to you and said, I am going to double your salary, but that's going to be exactly what I'm going to pay you for the next 30 years. Well, today that sounds like a heck of a deal. Guys, if you want to use this simple parable, I would strongly suggest writing it down right now because it's a simple way to understand how to explain inflation and why it matters to mortgages. So your employer says, I'm going to pay you whatever I'm paying you right now, I'm going to double your pay. Your first reaction is, oh my God, that's amazing. But then you start thinking about it and you say, wait a second, I was making 50,000 a year and now I'm making 100,000 a year. That's great today. But what if the price of everything I buy keeps going up significantly every single year? Well, 10 years from now, the 100,000 I'm making is really equivalent to the 50,000 I'm making today because the price of everything has doubled. So I might make twice as much money, but that doesn't help me buy more things. And now you got to worry, that was only 10 years in. You still got to survive another 20 years when prices keep going up. And now your $100,000 a year salary buys you less and less every single year because the price of everything has continued to go up. That's what mortgage companies are actually agreeing to. We're in a situation where we are saying, hey, we guarantee that you only have to pay us X number of dollars every single month for the next 30 years. That's our income as a mortgage company. And if inflation skyrockets, we know that those dollars we're earning down the road are not going to be worth very much money. Therefore, we want to raise the interest rate to outpace or stay ahead of inflation. And that might be you saying to your employer, hey, you know what? Sure, I'll take that deal. But instead of doubling my salary, I want you to quadruple it. Because I predict that making 200,000 a year, that'll help me outlast what the inflation is going to raise the cost of living over my lifetime. So that's why mortgage rates are afraid of inflation. And that's why we're seeing the fear of inflation cause this spike in rates. But John, where's all this fear of inflation coming from? I'll tell you where it's coming from. It's coming from $1.9 trillion of a stimulus package. You have a bunch of money that is being thrown into the economy. So you have the average person that's about to get a big check. They're going to go spend that money. Well, as they spend that money, it is going to increase the demand, yet supply isn't going to be increased. Therefore, the price of those goods are going to go up. But more importantly, guys, the government doesn't make money. Like the government prints money, but the government doesn't make money. So every dollar the government writes as a check to the population for stimulus has to come from the government raising money by selling treasuries. Again, basic supply and demand. If they need to raise money, they've got to entice investors to buy those treasury bonds. And to entice investors, what do they have to do? They have to raise the rates that they're willing to pay those investors to invest in treasury bonds. So stimulus is inflationary, and it is leading to concerns about inflation. An improved economy is inflationary. The economy is showing signs of healthy improvement. So we've really got three legs to this stool, okay? We've got the COVID case rate, which has been coming down. It's leveling off right now, but the number of new COVID cases have been coming down. That's good for the recovery. Vaccine rates have been going up. That's good for the recovery. The third leg to this stool, though, is the new COVID strains. And there's a lot of concern there that says, hey, even though case counts are coming down, even though vaccination rates are going up, if there's a wild card from left field of a new COVID strain, it could put us back to square one because it could be negating all of the improvement we've made with the current strains and the vaccine against those strains. So that's a wild card that we've got to be really, really perceptive of. But here's really what's happening. The markets is concerned for what we kind of call a melt up. So instead of a meltdown, like when your 2-year-old throws a temper tantrum and has a meltdown, this is a melt up where the economy heats up and gets super, super hot, super, super quickly. But guys, this melt up, this super hot expansion of the economy, I don't think it's real. Because what we're dealing with right now is we're dealing with restaurants that are opening up at 25% capacity. I don't know about you, but how can that be considered overheating the economy when we can't even fill a restaurant to its normal capacity? And we have restaurateurs that are still struggling to make ends meet. That is not the definition of a healthy economy that is going to be thriving. And I think that we've got a lot of perceptions here that are causing rates to go up. And I think the reality is the market and the economy is not going to be as hot as what they're afraid it's going to be. So here's where I think rates are going. In the short term, it's going to be all about perception, and perception, like beauty, is in the eye of the beholder. So from the person that is making these decisions, from the average Wall Street investor and the marketplace itself, the talk right now is about inflation, and I don't see that changing. I think we're going to be in a highly, highly, highly volatile rate environment. I think we're going to stay there through summer. I think we could easily see rates tickling up to the 3.5 to 3.75% range, because we're going to see that much volatility. And I could see us moving into that next coupon range, which puts us between 3.25 and 3.75. I do think they're coming back down. I think that once the what we call masks off, or what I've been hearing people talk about, masks off time, where people are back to work, there's a lot of concern that, hey, that's going to be great news for the economy, true, but they're concerned that's going to cause even more inflation because all these people are back to work. But the truth is, people are spending right now anyway. They have equity in their home, rates are super low, they're pulling cash out to refinance, they have money and they are spending. What's not happening is we're not producing anywhere near as many goods as we have been. We've had a lot of plants and factories that have been shut down because of concerns over COVID, or slow down in the productivity of those factories. I think once we have a more regular reopening where most people are back to work, we're not going to see high inflation at that point. We're actually going to see prices of goods come down, because companies will be able to provide more products. They'll be more productive in putting an output, and they'll be lowering prices because there'll be a glut of supply. So I think that's going to drive rates down mid-summer. Okay. The question is, what's going to happen between now and then? In the short term, I'll tell you, Friday's jobs report is super huge for the perception of the market. Last month, so the first Friday of every month, there's a jobs report at 5:30 in the morning our time. And last month, they revised the jobs numbers down, like way down, where they said we'd actually lost jobs between December and January, even though the unemployment rate goes down. Don't be fooled by the unemployment rate, because the unemployment rate ignores people that have stopped looking for work. So the unemployment, even though there are fewer jobs created, you can actually have less percentage of the population unemployed, because they don't count people that have said, I just give up. I'm not trying to look for work anymore, because for whatever reason, some of which is the market is just too hard to find a job, so I'm not going to try for now. And they take those people out of the statistics. So from what I read, the real unemployment rate's closer to around 10% of the population is unemployed. But this Friday is going to be a big perception reports. If job creation is strong, I believe we are going to see rates go up faster, because they're going to look, the markets is going to look at it and say, oh my gosh, job creation is strong. That's a bigger sign of health in the economy. And the healthier the economy, the more we're going to have problems with inflation. And the Fed has said they're not going to put controls in place to keep inflation down. The Fed's actually encouraging some inflation, and it's creating more concerns in the market. I think that if rates go up this Friday because of a good jobs report, we're also likely to see the stock market pull back some. So just be aware of that fact. I don't know that, obviously I can't predict the future, but just everything that I'm reading, this Friday's jobs report, we're going to see a big reaction. And it's either going to be a reaction because jobs are not created as many as they thought they were going to create, in which case I think rates will drop. If jobs are strong, I think rates are going to go up, and the stock market is going to be helped or hurt right along with it. So guys, really simple. I know I've covered a lot of stuff, but really it is perception right now that's caused these rates to go up. We have to be vigilant because perception is reality. What the market perceives to be true is the reality of the market. Now, I didn't see this coming in February. I knew that rates were going to be a little bit rockier. I told you guys that last month, but I expected them to stay pretty steady. And this definitely caught me by surprise because I don't see a whole lot of inflation coming into play. We definitely have no real inflationary numbers. We simply have the perception of inflation. And that is the sole fact that has been driving interest rates up so much over the last 30 days. All right, it is 3:29. I try to keep these to 30 minutes. So if you guys have questions, feel free to post them into chat or unmute yourself and holler out the questions. Otherwise, I just really appreciate your attention and the opportunity to help you out with this. And unless there are further questions, I'll wish you all adieu and have an absolutely amazing rest of your Monday. I'll hang out here for a minute in case you have questions. Otherwise, see you later.